All right, ladies and gentlemen, welcome to MACROACE with your host, Tony, also the head financial analyst at FinancialJuice. Don't forget to share the video with your fellow traders and friends. We have quite a bit to go through. We know we've seen the banking contagion from the SVB fallout and how it's affected Credit Suisse. And of course, we're going to go through the sentiment, what the release is all about, what to expect, what's been said in the past, and then look at the deviations for the economic release as to how the statement and the rate itself affected the markets. First of all, let's get right into it then. So what is the FOMC rate decision? So they meet roughly every 6 weeks over 2 days. Okay, so of course, today being the final day, and they started it yesterday. But this is where they set the policy and the federal funds target range, and to whether or not to be maybe to stick with the current policy that they have of maybe tightening policy or loosening it, or maybe deciding to change the whole thing altogether and just go all crazy and bat. But we know so far that they're still in their tightening phase, but we'll see what kind of comments we expect we see from the Fed or from Powell as well in regards to the banking turmoil that we've seen recently. Then, so the federal funds rate, of course, it's the rate that banks charge each other to borrow or lend excess reserves overnight as well. Now, why is that important? Because it causes volatile moves within the markets and affects the wider economy. Not just within the US economy does it affect, but it also has a bearing on how other economies might react, or other countries and their central banks might react to the Federal Reserve. Now remember, if the Federal Reserve if the dollar is a reserve currency, whatever the dollar is affected by, other central banks are going to be keeping an eye on it. So if it starts to move up in value, more than likely you usually see others who try to raise rates in tandem with the central bank, or try and follow similar moves to keep their currency on par, on level, or as close as they can with the value of the dollar, or make sure that the value of the dollar doesn't become too strong against their own currency. So that's why the Fed interest rate decision is very, very important to keep an eye out for. Although we have seen in the past where Bank of Canada being the first major central bank to take the rate pause, will the Fed follow through with that and do a rate pause for themselves? Well, today we'll find out. Or will they do a 25 base point hike? So some people already have questions for me so far. William, I will try and answer yours as soon as I can. We have a lot to get through. Hold on to it. Don't go away. Now, as said, it may influence other central banks to follow in the rate path. How does it affect the markets? What do you need to know? Okay, what else? What do you need to be aware of? So for currency, I already mentioned it earlier on. If the interest rate is raised more than expected, that will lead to a higher currency rate. And what the reason being is that international investors and traders will look to park their money or start to exchange their money in the dollar rather than a currency that has a weaker rate. So again, and also there's confidence in that country too to continue to do well. But of course, it depends on what the situation is and how far the central bank goes, and what the central bank is doing to kind of shore up the economy. And then that will have an overall effect on the currency. The stock market, easy, simple, nice and easy. Whenever you raise interest rates, if you're a business, you don't like high rate of interest because, of course, that means less profits, means you have to borrow. It means you have to pay back, borrow more money from a commercial bank, or you have to pay back more for consumers. Same thing again, you've got to think about mortgage rates going up. If they're, again, same thing, you're borrowing more money and you may be having to pay back more money than you originally, than maybe we have done in the past. So if you have these super quick rate hikes in the US and globally, what do you think? Of course, this can have a very immediate effect on consumers, which it has done so far. There's still a bit of time for the interest rates to take effect on these businesses. But thinking about the banks, the big boys and what they're saying about the turmoil at the moment. If we're going overseas to Credit Suisse, how they've been affected, how they've been Swiss cheesed is what I like to refer it to as. How they've been affected by the SVB fallout is what they're blaming it on, is what they said on the weekend, actually. Then there is there's a bigger chance of a wider contagion happening, which, it's very... It seems like it is 2008, but we've yet to see more data come through, and then see how other commercial banks fare. So the bond market. Now the bond market, very simple. Whenever rates are raised, the yield of the bonds go higher. One, because when the interest rate is raised, that usually means that the economy is, in a normal scenario, the economy is doing well. Okay, if interest rates are being raised, if the economy is doing well, and the central bank is stepping in just to kind of temper the growth a little bit, to kind of keep under control, what happens is that the bond yields start to go higher, and you see the yield curve also going higher as well. On the flip side, in a tiny environment, same thing. You see bond yields going up in anticipation of a higher rate of interest from the central bank, or monetary policy, or more monetary policy tightening, depending on what's said in the monetary policy statement. So bond yields go up, bond prices tend to go down when interest rates are raised. And again, we've got to think about if it's higher than expected or lower than expected. If it's as expected, you're looking to the monetary policy statement to see what's been said. But if the rate itself is much higher or lower than expected, then you're going to see that increase in volatility and stronger moves, rather than the usual whipsawing that we get when the data is as expected and the monetary policy statement is boring. All right. So where is the economy at the moment? So GDP fourth quarter at 2.7% versus third quarter at 3.2%. Inflation, as we'd seen, came down to 6% versus the prior 6.4%. PC price index slightly higher at 5.4% versus 5%. Consumer spending stronger than the previous round at 1.8% compared to minus 0.2%. Non-farm payrolls wasn't as strong as it was last time, still pretty strong and above the average 200 to 250k jobs that we're used to seeing, around the 200k average. But smaller than the prior of 504k, and that's the revised figure there for the prior release. ISM manufacturing PMI in the contraction zone at 47.7 versus 47.4. Usually economists say a figure of around 47.1 is when that sector is not doing well at all and is going into more of a recessionary territory. But as you can see, it's still, although it's in the contraction area, the zone, still trying to cling on as best they can and try to climb back up. Services side, 55.1 versus 55.2. Again, if we're thinking about inflation, where is inflation coming from the most? We know that the services side is picking up some growth there, particularly in the UK from the data report that we had for the UK, and why the pound went is because of the services side and the retail side of the UK's economy that really accelerated inflation in today's report. University of Michigan sentiment at 63.4 compared to 67. 1 year inflation expectations went further down to 3.8% compared to the 4.1%. 5 year inflation expectation to 2.8% versus 2.9%. Unemployment costs are 1% versus 1.2%. Then the previous FOMC statement. Now, if none of this is making sense, then do let me know. And I will try and answer your question as best as I can. William Riker says, Tony, I tried to trade gold today, and what I want to know is, can you lend me some money, please, mate? Let me go speak to my boy, Powley boy, Jerome, and let me see, let's go dig up some gold from the ground. Or maybe I will just try and revive the gold standard as best as I can, and see what the US has in store. If they don't, then I'm sorry, buddy. Then you're on your own. Mickey Lyons says, Tony, big fella, says you're amazing. Phil Faust says, Tony, are you expecting another whipsaw at 2 p.m.? We'll go through the rest of the prep. We'll go through the rest of the prep here, and then we'll kind of see. It's more a wait and see. You can say whatever you want to expect, but you don't know. You can only prepare yourself as best you can. What time is the rate said Abramo Parlor? It is at 2 p.m. Eastern time. Just doing an hour prep beforehand. Of course, you guys have questions. Master Roy says, if the Fed raises rates, will it hurt banks? Well, if you raise the rate of interest, you're hurting the wider economy, but you are going to hurt those businesses that are borrowing from those commercial banks. So in a way, yes, but no, because they're charging higher rate of interest, so they're getting more money for providing a loan. But if nobody wants to take out a loan because of a higher rate of interest, then it's kind of a double-edged sword in this environment. Anyway, so far, yeah. All right, so let's carry on. So the previous, hopefully, answered your question so far as best as I can. So the previous FOMC statement that we had, or the release that we had. Now, inflation has eased somewhat but remains elevated, is what they said. The committee anticipates that ongoing increases in the target range will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return to 2% over time. Committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and the economic and financial developments. This is when they said this the first time, the markets loved it. They took that as the Fed was going to start to slow down with their rate of their mega rate hikes of 75 and then slow down to 50 and now to 25. So there was nothing completely new or out of the blue from the Federal Reserve at the last FOMC. The committee said it would be prepared to adjust stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. If that is the banking contagion we're seeing at the moment, and the Fed decide to say, well, maybe not a 25, but maybe let's pause, it could be a possible scenario if they're really worried about the banking contagion and they don't want a repeat of, I mean, more or less you might just get a repeat of the 2008 financial crisis, but they're going to be more they're going to be quicker to try and curtail the bigger fallout of having high interest rates and raising them so quickly, and try to bring the economy or bring the money flow into control as best as they can. So that's one possible scenario. Next, Fed minutes from February 22nd. So you had participants said inflation in the last 3 months has eased, but they need to see more progress. Participants stated that the continued tight job market would contribute upward pressure to inflation. Some participants predicted an increase in the likelihood of a recession in 2023. Yeah. What do we see at the moment? There is signs of 2008 flashing, but it seems bigger because everyone's more interconnected with each other. That's more of an opinion from myself. Don't take that as trading advice. But in my personal opinion, everything is more interconnected. Everyone's more interconnected with each other. You've seen how quickly it affected a bank overseas across the channel in Europe with Credit Suisse. Okay, they've had their problems, but because of the shock from SVB and how that affected the US markets, within a week, you had Credit Suisse popping up in the headlines and causing turmoil as well. Several participants advocated raising rates by 50 basis points. Then if we look at Fed members, Fed's Powell says if the totality of incoming data indicates that faster tightening is required, we are prepared to accelerate rate hikes. But of course, that was before the last last inflation read that we had, and it was, it came in at 6%. So the Fed's job is working. Fed's bar said banks may face crypto risks on March 9th. March 8th is when SVB started to say they had some troubles creeping in. Okay, and the following day you had Fed's bar mentioning that comment there, and then late the next day, bang, it starts. March 13th, you had Powell commenting that SVB failure necessitates a thorough, transparent, and timely review. 14th, Bowman said the US banking system has substantial liquidity and capital, and the Fed board is closely observing developments, more or less saying everything's all fine, you don't need to worry about it, just keep calm and carry on, is what the Fed have basically said there. Although, we'll get to in a bit later, there are some other things and worries for the Federal Reserve and also the US government that they've got to take into consideration. Powell and Yellen in a joint statement on the 19th said the US banking, more or less what Bowman said, that the system is fine and everything is all good. Don't worry about it. Just keep your head down and carry on with what you're doing. We've got it all under control. Fed Watch. So this is very important, and this has been choppy since the SVB fallout and also with Credit Suisse. The traders have been trying to anticipate what the Federal Reserve will do, chopping from no rate hike this week to a 25 instead, for the last couple of weeks or so. But let's start off with, so Friday the 17th of March is when I looked at the CB Fed Watch tool. More or less, it is the same. But you can see here that the idea of a rate pause has increased in expectation. You can see on the 10th of March, or a week before that, there was no expectation of pausing the rate. But then since the fallout from SVB and Credit Suisse, that jumped to 20% and it was around 27%-ish. But the main forecast, or the main expectation from the CME Fed Watch tool, is looking at a 25 basis point hike instead. You can even see here a week beforehand there was more choppiness between whether or not to expect a 25, another 25, or 50, and the 50 just boom goes away. That's it. Forget about it. Don't even think about a 50 basis point hike. If for whatever reason the Federal Reserve goes with a 50 basis point hike, a surprise to the markets, you'd expect a lot of strengthening from the US dollar off of that. One, it's much higher than expected. And two, the stock market would not enjoy a 50 basis point hike if they're already priced in a 25 basis point hike. Okay. If you do get no change or pause in the rate, then the stock market would love it, because it means that the Federal Reserve has more or less taking into account the possibility of a downward trend in the US economy. All right, so let's carry on. So investment bank economist and sentiment views. So Credit Suisse debacle, what we had over the weekend, and I was sat there on the weekend, so looking at all the news that was coming out. The main thing is that the Swiss government more or less told UBS, look, you guys, listen to me. They went up to UBS's ear and said, look, please, we need your help. We need you to buy Credit Suisse. And UBS sat there looking out at the window on a rainy day in Switzerland with a cup of coffee in front of them, thinking, well, I don't know. I don't think I can. I mean, they've got I don't know what they're doing there, but it's like a zoo. They've been having issues forever. I tell you what. How about you give us $100 billion in liquidity? Swiss government goes, sure thing, hon. Anything for you. and then they're sold for, and then they buy them out for about 3 billion Swiss franc. Whereas Credit Suisse, having their issues that they had, are just kind of left there in that zone, taken over by UBS, and that helped the markets see a bit of positive momentum initially, until then again on more or less on the Monday, then the markets went back to the normal routine of becoming fearful of the contagion that comes from Credit Suisse, and then whether or not UBS could kind of hold on to or manage the debt or manage the issues that Credit Suisse has on their books. So that was the Credit Suisse debacle. Then, if we're looking at Bank of America CEO, he saw that, well, he expects that interest rates will begin to fall in the second quarter of 2024. I think that's probably changed to now expecting that maybe before the end of the year, but no further comment has been mentioned by him. Then on March 12th, Goldman Sachs. So what I'm doing here is I'm layering up with these comments how the sentiment has changed. That's quite key, and how quickly it's changed. March 12th, Goldman Sachs says, given the recent stress in the banking system, they no longer expect the Fed to raise rates at its March 22nd meeting. March 15th, Goldman Sachs said the small bank stress would have the same impact of growth as roughly a 25 or 50 basis point of rate hikes. They also lowered 2023 Q4 GDP growth by 0.3 percentage points to 1.2%, in part reflecting a larger downgrade to investment spending. March 20th, they expect, again, they reiterated that they expect the Fed to pause at its March meeting this week because of stress in the banking system. So even though a lot of, you could say you had the Credit Suisse issue that was, kind of resolved. I mean, they were just bought out. Doesn't mean their issues have been fixed. UBS has just taken on their risk, and taken on them. It's like taking on the stepbrother that you never wanted to be with, and there you go. He's now your problem. So then you have JP Morgan's chief economist Kasman said that they see the Fed moving 25 basis points today. And then the OECD said the central bank policy rates are expected to peak 5.25% and 5 to 5.5% in the US, 4.25% in the Eurozone and United Kingdom. Now, don't forget, tomorrow is the rate decision for the UK, where they're expected to do a 25 basis point hike. So the OECD is saying that they'll do the rate hike and then that'll be it. They'll pause. And then the only other surprising thing is, even after the fallout from SVB and how the Credit Suisse crisis had caused market fear, you still have the OECD seeing the rate going, to 5.5% rather than a pause. Now, you could say that they had data, or they were collecting data from before the crisis or the banking crisis had begun, or contagion had begun. But it could be that they had gathered the data after, or they were still gathering data even after the initial fallout from SVB. But for that to be put out then, you kind of got to take it with a pinch of salt, whether if you're a dollar trader thinking that the rate might still continue to go higher in this current scenario that we see. Market pricing then, a lot of market pricing. Fed swaps priced in 50 basis point of rate cuts by the year end from June peak. Feb 3rd, they priced in a peak policy rate of 5% for June. 14th, post the hotter than expected report in January. Fed swaps no longer price in 2023 25 basis point rate drop, except they price in term rate of 5.27%. 24th Feb, they price in a policy rate of 5.45%. So it starts to climb. Okay, remember the jobs data that we had. Okay, that was much better, much higher than expected, with 500,000 jobs being handed in. And then you start to see the pricing from traders going higher. Okay, March 7th, Powell added to the fuel as well, saying that Fed's and then with his hawkish comments, and that that they more or less open to continue raising rates, that they're not done yet. And then Fed swaps priced in a high peak policy rate of 5.61%. Okay, in September, reprice bets to favor 50 basis point hikes in March over 25. So you can see within a short period of time, right? Look at that. 3 days later, post NFP, the data had changed the market sentiment or the pricing in. Fed swaps downgrade odds of 50 basis point March rate hike to 150%. It gets better. Post Credit Suisse, Fed swaps price in 100 basis points of cuts by December from its expected peak, or during the Credit Suisse crisis, should I say. So the fear of contagion from SVB and the fallout from there, okay, that had caused the traders to expect, okay, actually the central banks are going to pivot, and rather than continue tightening monetary policy, they're going to ease monetary policy instead. 17th, the Fed is to raise Fed funds rate by 25 basis points in March, according to 76 of 82 economists. 5 said a pause, and 1 said a cut in a poll. March 20th, Fed fund futures traders see 73% chance of a quarter point hike on Wednesday and boost the odds of a May hike. So it all depends on what the Fed says today, whether or not we do get a May hike, or if they decide to pause today and then they decide to provide dovish commentary where the economy is at the moment. How bad is it affecting the mid-sized banks, which I'm going to talk to you about now, and then what are the next steps they can take. So this is very worrying too. When I was talking about mid-sized banks, now on the 18th of March, Mid-Size Bank Coalition of America, in a letter to regulators, they asked the FDIC to ensure all deposits for 2 years. Not a week, not a month, 2 years. Now, what does that say about the banks and the liquidity that they have? Well, it obviously says that they don't have enough to cover anyone who wants to, first of all, if they want to take out their cash, they probably don't have, they might not have enough. But for 2 years, it's quite a significant amount. Or they're expecting a recession to happen and for it to last around 2 years, the initial brunt of the recession. Or because of how SVB turned out, that the Federal Reserve and the government jumped in and say, hey, and the FDIC jumped in and said, hey, we'll protect your depositors. That's the most likely scenario that they're taking, that they're going to try and take a similar move. Think about back in 2008, where the banks were literally being bailed out by the central banks. They weren't thinking about the depositors, they were just thinking about the bank itself. This time around, if they're trying to protect the depositors, they're trying to give banks a little bit of a breather to be able to shore up any monies that these commercial banks have. But how long does that last? I mean, yeah, you can print money for a very long time, but then what happens to your currency? When you print money, it devalues your currency. So how long can you do it for before you have to start taking other measures? Or maybe let go, and then you let start letting commercial banks fail. Or maybe they're bored, and maybe they do a similar thing where what they did with Credit Suisse is to let another commercial bank jump in and buy their bank out to then take on the issues that they have and then try to fix it and make it better as best they can. So those are the possible scenarios they have, but that comment that come out from the letter wasn't very promising. for anyone considering the long-term effects of the fallout from SVB. Yeah, it is a bit of speculation right now. That's not that probably is going to happen. Maybe we just got to, as an analyst, you got to try and think of the different scenarios presented and then come up with your own opinion. So please don't take what I say as your own opinion. Just kind of think, open your mind, have a little wonder with your thoughts, unless you've been doing them the whole week. All right, Svb Swiss Cheese. So if we're looking at how we would have started out on March 8th, the bank lost about 1.8 million on a sale of bonds. 10th, financial deposit outflows were outpacing the sale process. SVB 2023 bond spread widened to 1,061 basis points, indicating stress. And Fed swaps priced in 50 basis points of rate cuts by the year end, and stocks were still dying, as in, i.e., taking a hit from it. Then March 13th, traders saw a 54% chance of Fed holding rates March 22nd and a 46% chance of 25 basis points. If we kind of go forward, then you see how other markets were affected. So US listed shares of Chinese companies fell pre-market after contingent fear from SVB, more or less saying that no one is safe. Following SVB, as said, the Fed was considering tougher rules for mid-sized banks. And then forced weekend shopping, like I said, with this Credit Suisse, more or less having to buy Credit Suisse. Otherwise, it would have had an even bigger effect, and then you would get a real dirty contagion from Credit Suisse in Europe, and then the rest of the world. Okay, so let's look at the previous rate decision and how that played out. Okay, so bearing in mind we're looking at how the release reacted previously on February the 1st, and we'll see how the markets took it. Right, so this is about less than 10 seconds before the release we had last time around. Kind of let it play. So the rate came in as expected with a 25 basis point hike. You had seen that initial move towards the downside, or the whipsaw effect that had come across. Now, when we look at the deviations, key thing is the Fed repeated that they're anticipating ongoing rate increases will be appropriate, and so the inflation has slowed slightly but remains high. So if the Fed at today's meeting says they need to continue raising rates and they see that as appropriate and don't mention anything about SVB, you could see a bigger reaction in favor of the dollar if the Federal Reserve doesn't consider the SVB fallout to have a big impact. Now, we've kind of been given some hints from Powell before as well, as I said, saying that the financial system is resilient and strong in the US, and maybe that, forgetting about what the mid-sized banks have said, that they probably need, help with their deposit, potentially help with their depositors for 2 years. You're not really painting a nice picture there for the US economy. So if we do get a repeat, but there we go. So, you saw the initial market reaction, but there was no indication of a rate cut could occur, which led to a decline in stocks. But the repeat of what was said before led to stocks going up. So there wasn't really anything new or surprising that came out from the Fed at this meeting here. So if we kind of keep going forward, see how the markets were. So you can see it was quite choppy in the indexes. The dollar had a better round of movement. It's particularly the dollar yen. Cleaner movement. That's the 2-year bond price here on the right hand side. They had a nice clean initial move. Okay, keep going forward. All right, so that was the economic release there. Let's go through the deviations then for the economic release. How much did the Fed's interest rate decision and the statement affect the market? So if you're unfamiliar with what the deviations are, deviations basically show you how much the economic release has affected the different assets, currency, stocks, metals, your gold, and your bonds. Okay, and then here I've got your sentiment as well. Now, first, to make you aware, so this represents the initial move. Okay, and that goes to the wick of the candle. I always like to capture the initial move from the economic release, and then the figure in the brackets shows you the movement 10 minutes after the economic release, going to the end of the candle. Okay, this is all on a 1 minute chart that I've just collated the data, curated the data on. Okay, so you can see that the stock market, although there was the continuation of the expected rate increases, there was nothing else new or shocking from the rate statement. So you had seen initial 81 ticks was the downside, and then 34 ticks were back towards the upside after about 10 minutes of trading. Nasdaq in Q 245 down, and after about 10 minutes 207. So again, whenever the rate statement, if the rate comes in as expected, and the rate statement doesn't offer anything new or exciting, then it could lead to more of a choppier reaction, where you might see stocks taking a move. You might see stocks going in one direction and then flips, goes back in the other direction instead, or more or less ignoring the statement that's been said by the Federal Reserve, because again, there's nothing new or exciting to kind of mull or get your teeth into. So we can see the biggest reaction within the markets, currency pair wise. Okay, on the dollar yen, consistently has had the biggest reaction. Besides back in September, where we've seen that, and also back here in that is 4th of May. May the 4th be with you. But consistently so far, up until now, it's had the biggest reaction within the markets. Think about the policy difference of the Bank of Japan and the US. The US is raising rates, Bank of Japan isn't. They're still sticking with their monetary policy easing. So it makes it, that's why we had a nice cleaner reaction on the dollar yen compared to the other currency pairs, because everyone else is also raising their rates. And it makes it harder to see how, and then the difference is who's raising rates more compared to someone else. And then you kind of have to pick and choose. So you had dollar yen, so you had seen the biggest movement last time around. You can see that after 10 minutes of trading, that a lot of the initial reaction that was there had started to creep back or pull back a little bit after about 10 minutes of trading. Even on some currency pairs, actually, flipping and going towards the other way. So even though on the cable, you'd seen an initial 20 pip move down, after about 10 minutes of trading, it was more or less flat after the 10 minutes after the release. If we're looking at the bonds, though, the biggest reactor to interest rates or economic releases that we've seen consistently in the past has been the 2-year bond, because that's the most rate sensitive bond within the yield curve. And compare it to the 30 years. So the 2-year bond has seen the biggest market reaction compared to the 30-year. So that's if the rate is as expected and there isn't anything new as provided by the Federal Reserve. Now, I said that the Federal Reserve repeated their rhetoric of anticipating ongoing rate increases. I think I said this earlier, but if in this environment they decide to say that we need to continue raising interest rates, and if they say anticipating ongoing rate increases will be appropriate, rather than saying that rather than kind of cutting back on that aggressive language, that could make the reaction, as I said, it could be more in favor of the dollar in this current environment of the market, of the banking system turmoil that we're seeing at the moment. Just be careful of that. If they repeat that and they don't see more dovish then the markets expect, or the markets might be expecting them to be. They've had quite a bit of time now to kind of take in what's kind of going on, and if those guys aren't, if they're not up with it or down with what's going on, help me God. All right. So that was the previous market reaction. We know consistently dollar yen has had the biggest market reaction in the currencies, and then the 2-year bond price has had the biggest market reaction as well. All right. Now, for the other scenarios, if the rate comes in lower than expected, okay, or if it comes in at a pause, or if they decide to flip it and pivot now and they go for a rate cut, then you'd expect the stock market to love it and the dollar to hate it. Okay, as I said, it's more of a confirmation that they're taking a pivot to try and support the economy, and they'll be the first major central bank to do a rate cut rather than pausing rates. So if they do decide to do it, that'd be nuts. Nobody's pricing it in, or nobody's priced that in. Maybe one economist has out of everyone else, but none of the other major central banks have said, major commercial banks have said that there's a chance of a cut happening. More or less just there's a mix, something in this, there might be a pause rather than a 25 basis point hike, or the other way around. I would love it if there was a 25 basis point cut. Okay, yeah, Ukamaka's right there with a 4-leaf clover. Ken and Lewis, the stock market at all-time high in 1 week if they pivot. Mickey Lyon says, might take 25 basis points will shoot the market a little bit, and suddenly dovish comment will bring it down. So closing somewhere flat, rest Powell is the king. He is the king of the jungle. But yeah, so, and then on the flip side, if the Fed decides to go with a 50 basis point hike, even though inflation has come down, and is coming down, at a nice amount, then again, we'll just have to look at the comments and see why they've come with a 50. But if the most likely scenario happens with a 25 basis point hike, key things in the comments that we want to be aware of. Of course, today we're also getting the summary of economic projections too. So if in the summary of economic projections they start to see a smaller, if they start to claw back with or pull back on their expectations for where the rate, where the interest rate should be, or the terminal rate should be, or where the federal funds rate should be, then that would help the stock market. So we've got quite a bit of data to go through. I'm just going to bring it up here. So this is the last time we got the summary of economic projections. So they expected the federal funds rate to be at 5.1% in 2023. Okay. Now, and then in 2020, now, if they see the rate at 5%, and then in 2024, or maybe where the rate would end up maybe lower, if they do decide to want to cut rates later on in the year, if it is lower than 5.1%, or let's say lower than 5%, should I say, okay, then that would help the markets move towards the upside of the stock market, because then they will know that the Federal Reserve might have the intention of cutting interest rates this year rather than in 2024, is what the previous summary of economic projections was looking at. So that's going to be key, okay? The summary of economic projections. We don't want to miss out on that there. I'll just kind of, I'll bring it across here. See right here. Yeah, so it's going to be quite important here for the summary of economic projections. What we're going to be getting today. And also if they have a lower inflation expectation, that's also going to help the stock market. But the key thing is going to be to see what they do this year. If they expect a smaller, if they do decide that they want to cut interest rates before the end of this year. If they go with if they expect a higher rate of interest this year, and then also for maybe even for next year, then that could lead to the stock markets actually taking a hit if they still expect a higher rate of interest than 5.1%. And that wouldn't give, that would be like a gut punch to the markets and a punch in the teeth. Yeah. And there you go, wham bam. Forget the SVB fallout. We're gonna kick your butt. And then there we go. That's how the markets will react. But this is going to be important too. The federal funds rate and the projections, what they see. All right. So let's get rid of that. Get that out of the way. Now, if you wanted to have a look at the summary of shorting alpha says Goldman Sachs wants cuts, therefore it will not happen. Shorting alpha says fantastic spreadsheet. Tony Kulush says, hi Tony, it's Tony. Hey Tony, my twin brother from another mother. Mickey Line says, gonna grab coffee and be right back before the session begins. Tony raised the power to 2. Sony said, lol, that sounded like a horrible Aussie. Tibor Jorgensen said, lol, that sounded like a horrible Aussie accent. I was trying to be, I think I was trying to be American, but, well, that's my acting career gone down the drain. Right. So now, FinancialJuice, the live voice and text service. Okay. If you are not familiar with what a live voice and text service is, it is something that the big boys have access to. They are able to, first of all, manage their trades, capitalize on potential trades, and understand why the markets are moving. So it's something that retail traders don't really have access to. Okay, your average day trader, they don't have access to. They might not have heard of it, or they may have heard of it, but maybe it's something that they're not used to. So this is something that's quite key. FinancialJuice, okay, providing live voice and text data all in one place. This is a website. So you have your voice feed here, and then here we have the news feed or the text headlines of, you can see we have the Bank of Canada meeting minutes that come through. Okay, that's all in one place, and also your economic calendar in the left-hand side as well, of all the upcoming economic releases that we have for the week ahead. And then we have a need-to-know market risk to tell you what to be aware of, what could affect the market sentiment, or what could affect the risk in the market, or what's happened now that's having an effect on the markets right now, or more or less, or it's continuing to have an effect on the markets. That's in the need-to-know market risk. Everything's all here in one place. So FinancialJuice, the live voice and text service, you can get that if you want to sign up for that. Again, particularly if you're a day trader, you want to know why the markets are moving. If, okay, fair enough, you can just look at the charts and then do whatever you want to do with it. But to understand why the markets are moving, that's a big advantage. That's another tool to add to your arsenal. Okay, it's something you don't really want to you don't really want to miss out on. If you don't really consider if you've never really played around with a live voice and text service, or never really thought about it, have a go. There is the free version too. So I'm going to put out the link in the chat for you. Completely free. You can, there we go. That is FinancialJuice. Sign up with an account, then go to email, verify it, come back to the site, and then have a little play around with it. Now that would be the delayed version, okay? If you're on the light mode version of FinancialJuice, if you don't want to pay for it, if you just want to have a little go around, a little play around with it, see what it feels like. There is a delay to the light version. There are also adverts that play as well with advert banners. The pro version of FinancialJuice, okay? If you have, first of all, you need to make sure, if you want to go straight to the pro version, Make sure you have an account first on FinancialJuice. Sometimes it's happened where people, go straight to the payment system and then, don't have an account. And anyways, you want to kind of prepare yourself a little bit better. So I'm going to help you with that. So all you got to do is make sure you have an account with the login details. There'll be a button here which says Go Pro. Click on that. Choose a subscription that you want to choose that what works for you. There's also a 7-day free trial of FinancialJuice Pro as well, if you're not sure about it. Go ahead, put your details in, go back to the FinancialJuice site, log out if you're already on the site, and then log back in, and vice versa. Just make sure you log back into the website, okay? And now it'll act as like a refresh to say you are now a FinancialJuice Pro member. Okay, and then you'll see this logo here, and you see the beautiful site that I see here, all in one place. We have about 9 minutes left. So FinancialJuice, have a little play with it. See what see what you think. See what you think of it. See what you make of it. We've also got Tickstrike as well, which I'll just open up here for you. So Tickstrike. Who's played with Tickstrike before? If you play with Tickstrike, give me a hell yeah. If you haven't, then I'm going to teach you about why and what it is. So Tickstrike allows you to listen to the order flow of buying and selling momentum within most assets. That includes stocks, crypto, forex, futures, your internals as well. Yeah, John N saying hell yeah, Ukamako saying me. It allows you to listen to the order flow and see it and be able to get alerts visually and audibly about how strong the buying or selling momentum is the best way to put it. Okay. So that if I just kind of get it away. So these boxes here are the tickers. Okay, and this shows you the amount of the strength of the buying or selling momentum within that asset you're looking at. Now, forget the color. What you want to focus on is the minus and plus next to the numbers. Minus showing you the amount of selling, that the strength of the selling that's going on, and then vice versa. The number is the sensitivity of that ticker. Level 1 is the most sensitive to market reactions. So when there's a little bit of, if I bring up gold for you, just so you can kind of see it, because I'm kind of moving around the most. If there's a little bit of buying or selling that goes on that meets the criteria for Tickstrike to go off, it will go off. As it's currently going off now, you can see there's a little bit of selling going on, and gold is, flashing up with that there is selling momentum here. Now you can adjust that level of sensitivity. So you can chop and change whatever you want between 1 to 15. 15 is the least sensitive to market reactions. So only when there's a big amount of buying or selling momentum that is going on will Tickstrike give you a visual or audio alert. I've currently turned off the audio, otherwise you guys will be hearing it and it's not nice. It'll be too much. But that is what Tickstrike is. So again, if you're a day trader or you were looking to scalp the market or manage your risk, again, it's another tool to add to your arsenal. And there is also a 7-day free trial of Tickstrike as well. Creativity Forest says, what are those boxes? JS with a worried face. Don't worry about it. This is just my setup for the, for looking at the US releases. There's quite a bit here that we have. Let me just kind of, I'll kind of leave it out. I'm going to leave it there. So I also need my bonds. We've got about 6 minutes left to the economic release. But don't forget, if you like the video and you've liked the video so far, share it with your fellow traders and friends. Get the word out there. We've still got a bit of, mulling over to do of the comments that come through, or the statement that comes through, and also with the summary of economic projections is going to be very key to see whether they flip their forecast for where they expect the federal funds rate to be, whether or not they might indicate rate cut before the end of the year, or if they stick by their guns and decide that they might go even higher, because Who cares about the US consumer, everyday consumer, huh? Forget about it. I hope they don't feel like that. Well, you never know. Anyways. But anyway, so there we go. That's my 2-year bond price there. So I've got what I'm looking at. Of course, if you're not sure what I'm keeping my eye on, I'm taking around the dollar yen, S&P, 2-year bond price, and gold as well. So there we are. Somebody said, "Is there?" Oh, we're on 420. People are. Could have kept it at 420. If you boys know what I mean. If you peeps know what I mean. But yeah. So anyway, so as said, if you're talking about the free version of FinancialJuice, Greg, yes, there is a delay to the free version. The pro version has no delays, no adverts. You also have access to the news desk as well. You can ask us questions about what's going on within the markets, and kind of understand, or maybe try and understand the news better, if there is any more detail to a bit of news that's come out or not. But that, again, free version. Drugs are illegal. The legal ones are called prescriptions. Well, now, depends how much you take of them. Anyways, but yeah, so free version still useful. You can have a little play around with it, see if it kind of fits in with what you want to, if it fits in with your trading strategy. But again, it's another tool to play around with, and then see if that works for you. That is Tickstrike. Now, MACROACE for the mailing list. You can also get the deviations as well. This is how we get the deviations. The deviations, just to let you know, if you say is it free? Yes, it is. It is free. It is super free. That I'm gonna send you an email once a week on a Sunday with the deviations, a summary of the weekend news, a bit about what to expect for the week ahead in the US, Europe, and Asia session, and also the link to the live streams as well. So yes, it is free. In that email, it doesn't have a big old bunch. It doesn't have a lot of charts or graphs. That's kind of kept simple, and I go through that with you here in the live stream with you here, and that's where the honey is. It's right here. Whew. Well, yes, we have 2 minutes left. 2 minutes. 2 minutes remaining. We'll see. Does the Fed go with the expected 25, but upgrade or downgrade? But downgrade the expectation for where the Fed funds target of federal funds rate is going to be? Or is it going to be boring? And they don't mention any of the fallout from SVB at all. That's what we're going to be keeping an eye out for. There's quite a bit of pressure on the shoulders of Powell, who is ready. Hopefully you guys are all ready. Yes, Bricktop, hello to you too. Let's go. Let's freaking go. Let's get that energy in. Pump it up. Let's go. Good luck, everyone. And let's get that going. Okay, 1 minute to go. 1 minute till the rate decision. Holy moly, baby. Okay. 25 basis point hike or no change. What do we get? What do we get? What do we get? Okay. Let's see. Da-na-na-na-na. Okay. Okay. 10 seconds remain. Let's see what the boys do. See what happens. Hike, 25 basis point hike, 25 basis point hike as expected. So that's in line with expectation. So let's look at the comments then. Okay, all right. So this is very key. So Fed saying that some additional policy firming may be appropriate, but gets rid of the reference to ongoing increases. That's why the dollar is going down, and the S&P is going up. Bond prices also going up as well. Fed says inflation remains elevated. Job gains have picked up, running at a robust pace. It will continue reducing balance sheet as planned. So again, the 25 base point hike as expected. Now it's the statement that seems more dovish. Okay, that's leading to the S&P seeing strengthening. The stock market seeing strengthening as a risk on reaction. Fed projections imply one more 25 base point rate hike this year and 75 base points of rate cuts in 2024. Fed policymakers see slower 2023 GDP growth, low unemployment, and less progress on inflation than they saw in December. Median view unchanged of Fed funds rate in the longer run at 2.5%. Fed funds at the end of 2023, again unchanged at 5.1%. So you're more or less getting a more dovish central bank here, but just kind of sticking to their guns with their expectations for the federal funds rate. Okay, so we didn't get the super dovish central bank. What else have we got? Tighter credit, the likely to see tighter credit conditions that weigh on economic activity, hiring, and inflation. Here's something that you don't want to see. Fed median view of Fed funds rate at the end of 2024 seen at 4.3% versus the previous of 4.1%. What else have we got here? 2025 Fed funds rate at the end of 2025 unchanged at 3.1%. That's more or less there. So dollar falls. We see dollar did to that initial hit from that Nagel, man. ECB's Nagel. Shut up. We got bigger fish to fry here. But he does say that we're approaching restrictive territory with interest rates. When we get there, we need to stay there. Okay, so that was the decision. Let's do some. Inflation is down. So the rate was as expected, but we had a slightly more dovish central bank and we'll go back to it again. So that's the dot plot plan there. Okay, so they remove mention of ongoing increases. Okay, so additional policy firming may be appropriate. So basically saying one more 25 base point hike, and that's going to be it. I don't see them mention anything about SVB or what's going on within the markets at the moment. Here's some important market moves. So US 2 to 10-year Treasury yield curve inversion narrows to minus 50 basis points after the Fed rate decision. Okay, so there's remember, if you have an inverted yield curve, right, going in a downward hill motion, that shows that there is what traders and economists usually see that as is that there is the expectation for a recession, or a very strong likelihood that there is going to be a recession. If that starts to flip and go back towards into an upward hill slide and to an upward slide, that leads to the expectation that things are better in the economy is growing, or it's stronger, or it's recovering from maybe a recession. And in this case, I mean, we're still, overall, we're still in an inverted yield curve. We're not out of it yet. But that shows that, the economy, that the Fed may be, maybe looking to support the economy a bit more by removing that reference of ongoing rate increases, or maybe, not being that aggressive, should I say. Take that back, not being that aggressive. Right, let's do measurements. Let's see what was the reaction on the S&P. Okay. So 81. Whoops. All right, so that's about 82 ticks there. I think the dollar. Let's look at the dollar yen. Okay. It's about 63 or 64 pips down on the dollar yen. I do want to measure against other currency pairs. But we'll go to bond prices, see how they're fed, and then gold as well. See what's going on. 98 ticks, or about 99 ticks. Gold, hey, look, gold. Let's kind of look here. Okay, let's see. I mean, to be honest, that is about 132 ticks there. Okay. All right. Okay, so dollar is continuing to head towards the downside. Hopefully, everyone understood my summary of what the Federal Reserve has done. If you haven't, do let me know, and I will repeat it again. Got some comments coming in. Oh, well, before the rate, somebody said, we're masters of the universe. Let's make that paper. Mickey Line, Hyper Hydros said that there. Mickey Line says boring, possibly. This is all the 1 minute before the release. Casasa Luis said 25. Jay said 50. So look, post market. So Kin Lu saying Bitcoin dampen. Who said dampen? Bricktop said thanks Tony for the stream. Have a nice evening. Thank you too. William Riker. I don't need to borrow that money anymore. Thanks, mate. Hey, that's good to hear. I'm glad you don't. Probably don't even want to borrow the money. I'd probably be like a loan shark. I'd say, hey, look, central bank might, commercial bank might be charging this much, but because you're going from me, I want to charge you, let's say, 50%, huh? How about 50? And Gordon Riker said also great coverage. Thank you, Tony. Thank you. Almuru says, please repeat summary. Was late for the game. Sean Stinson says, your news was ahead of mine. Thank you so much. Now, a summary again. So, the Federal Reserve more or less repeated what they said last time in the previous statement. The only key bit that they mentioned or removed is that they removed the mention of ongoing increases. Okay, if they had kept that in, the dollar may not have dropped as much as it has dropped so far. Now, the stock indexes wouldn't have seen a bit of wouldn't have seen a rally. They might have seen a flip side instead, if the central bank wasn't kind of peeling back with their hawkishness. So in summary, they're being less hawkish, okay? Because they've remember they've kept their expectations for where the federal funds rate is going to be at the end of this year at 5.1%. So they're more or less, they've got one more hike to do, and then they're done. Is what Fed projections show there'll be one more 25 base point hike this year, and then 75 base points of cuts in 2024. So again, so here we go. Look on the FinancialJuice feed, we've got not only the the headline. Let me get rid of Tickstrike out of the way. Close that. So here we go. So not only do we have the headlines that's come out, and you know why the markets are reacting in the way that they're reacting. You've also got it here, charted data's the headlines charted onto the markets here. Okay, you have that view there too. So if you do decide to come afterwards after the rate decision, help you God. If something were to happen and they decided to go bat nuts. But at least you have an understanding from, on FinancialJuice how the market's reacted to a particular comment or comments from a person or a central bank. So yeah, more or less everything's the same, but they're less hawkish. And if they got one more rate hike to do, 25, well, that's what the projection is, then done. Then they're done. Then they'll make them if the Bank of England doesn't pause tomorrow, then they'll make the Federal Reserve, or compared to the RBO or the RBNZ, the second major central bank to pause their rates after the Bank of Canada, if they do decide to want to do that. Alrighty, there we go. There she blows. So that was the live stream. Tomorrow we have the Bank of England. So I'm going to pop out the live stream for you guys there, so you can join me there live. That's going to be an interesting one to watch too. You don't want to miss out on it. If you do miss out on it, well, you never know, because they're expected to either maybe go with pause or stick with go ahead with a 25 basis point hike. But don't forget, as I said, to like the video, subscribe to the channel, and I just closed the link to the video that I wanted. Like and share the video, subscribe to the channel, get the word out there. Let's get those fingers pumping. Okay, pumping like Nikes. Let's go. Let's get the link here for you. Okay. That is the live link for tomorrow with the Bank of England. Ladies and gentlemen, and also finally, unusual activity. Okay, so if you like trading high probability stocks, futures, forex, and crypto breakouts in real time, well, then you can sign up for unusual activity and have a play with that, see how that goes for you as well. And then there is a free trial there. Have a little play with it and see if that works for you too. All right, but it would always be great. I always enjoy feedback, whether it be good or bad, because if it's bad feedback, then I've got a lot of work to do, or we've got a lot of work to do with MACROACE to make it even better for you guys. If we are doing great, let us know. Tell us why we're doing great. Show us your love. All right. Thank you, ladies and gentlemen. I will catch you tomorrow, and I will enjoy the rest of your evening. Goodbye.